If you open up your brokerage app today, you know, you might actually think we are living in a golden age. I mean, the S&P 500 and the Nasdaq have just closed at absolute all-time record highs here in early May of 2026.
Yeah, they're just absolutely surging right now.
Right. Tech companies are basically printing money.
Yeah.
But if you close that app and walk into a grocery store or just read a global news headline, you're greeted by an entirely different reality.
Oh, completely. It's jarring.
It really is. You're seeing surging inflation, heavily disrupted supply chains, and, this escalating energy crisis. It honestly feels like a severe case of cognitive dissonance.
It's a profound split-screen economy. That's the best way to describe it. We are witnessing this historic collision between the fragility of the physical world and the, well, just violent acceleration of the digital world.
Yeah.
And those two forces are currently engaged in a massive high-stakes tug-of-war for the future of the global markets.
So what does this all mean? Because that is the exact tension we are unpacking for you today. We have a formidable stack of sources on the table, pulled from late April and early May. We're looking at reports from the World Bank, policy decisions from global central banks like the Fed, the ECB, and the RBA.
Plus a whole flurry of first-quarter big tech earnings reports.
Right. And our mission in this deep dive is to break down how these colliding forces are dictating the new winners and losers in tech, driving central bankers completely up the wall, and ultimately dictating the bottom line of your personal finances.
Because to truly appreciate why those stock market highs are so gravity-defying, we have to start by measuring the sheer force of the macroeconomic headwinds that are, actively trying to pull them down.
The physical economy is sustaining multiple simultaneous shocks right now.
It really is. The most immediate threat detailed in the recent World Bank report centers on the Middle East conflict. Specifically, the ongoing disruptions in the Strait of Hormuz.
Let's contextualize why that specific body of water dictates global pricing. I mean, the Strait of Hormuz isn't just a shipping lane, right?
No, not at all.
It handles roughly 35% of all global seaborne crude oil trade. It is literally the central artery for global energy. And the World Bank is now reporting an initial supply reduction of about 10 million barrels per day due to these disruptions.
And just to be clear, a 10 million barrel a day reduction is the largest sudden oil supply shock on record.
Wow, record-breaking.
The mechanics of the energy market basically dictate that when supply constricts that violently, prices just have to surge to destroy demand. So we are looking at Brent crude forecasts averaging $86 a barrel this year.
Which is high, but it could get worse.
Oh, much worse. The World Bank includes this really severe warning. If critical infrastructure suffers further damage and the escalation continues, we could see Brent crude easily average $115 a barrel throughout 2026.
Which brings us directly to your wallet, because it is incredibly easy to hear a number like $115 a barrel and just assume, well, the only consequence is a more painful trip to the gas station.
Right, you think of the pump and that's it.
Exactly.
Yeah.
But the domino effect of an energy shock infiltrates every single aisle of the grocery store. Let's trace the mechanism here, specifically looking at agriculture.
Yeah, so energy is the baseline input for human survival, really, because it dictates how we grow food. Natural gas is the primary raw material used to produce nitrogen-based fertilizers.
Specifically urea, right?
Yes, exactly, urea. When the global energy supply is shocked, the cost to manufacture that fertilizer just skyrockets. The World Bank notes that overall fertilizer prices are projected to jump 31% this year.
And urea, specifically.
Urea is surging an astonishing 60%.
Wow. So farmers are suddenly paying 60% more just to coax the exact same yield out of their field.
That's right.
They have no choice but to pass that cost down the supply chain, or they simply plant less.
And both outcomes lead to the exact same destination, which is skyrocketing food prices. When fertilizer affordability collapses, global crop yields drop.
And the human cost of that is staggering.
It really is. The World Food Program estimates this specific agricultural pressure could push an additional 45 million people into acute food insecurity this year.
It's just wild to think about.
So the journey from a disrupted strait in the Middle East to a 30% price hike on your weekly groceries is just a direct mathematical certainty at this point.
Okay, so we have an unprecedented oil shock and an agricultural crisis. Now we have to factor in trade policy. The Supreme Court recently struck down President Trump's sweeping reciprocal tariffs.
Right, that was a huge ruling.
And in response to that ruling, He implemented temporary 15% tariffs on other countries. Now, putting the politics completely aside here, let's just look at the strict economic mechanics of a tariff.
Okay.
It is essentially a tax placed on an imported good, but the foreign country doesn't pay it. The domestic company importing the good pays the tax, and they immediately pass that cost on to you, the consumer, at the checkout counter.
Exactly. It acts as an artificial price floor. So you are combining a 15% baseline cost increase on imported goods with record-breaking energy and food inflation.
It's a massive squeeze,
It creates an inflationary cocktail that is notoriously difficult to cure.
which perfectly explains the fractured, chaotic response we are seeing from global central banks right now. I mean, they are completely out of sync on how to handle this.
Oh, entirely.
The European Central Bank opted to keep their interest rates unchanged, essentially holding their breath.
Right.
But Australia's RBA took a totally different path.
Right, they hiked.
They actually raised their cash rate to 4.35%, explicitly citing these new energy shocks and the upside risks to inflation as the catalyst.
Yeah, Australia is basically acknowledging that the inflationary fire is catching again, and they are trying to suffocate it early. But the most alarming signal comes from the United States Federal Reserve.
Yeah, let's talk about the Fed.
So, at Chair Jerome Powell's final meeting, keeping in mind he will transition to a governor role as Kevin Warsh prepares to take over, the Fed decided to hold their benchmark rate steady at 3.50 to 3.75%.
But the decision itself isn't the crazy part. What makes this meeting historic is the vote itself. It was an 8-4 split.
Which is unheard of recently.
Right. The last time we saw 4 dissenters at a Federal Open Market Committee meeting was October of 1992.
Yeah, 34 years ago.
For over 3 decades, the Fed has operated on strict consensus to project stability. So having 4 officials publicly break rank tells us the underlying economic data is incredibly conflicted.
And the dissenters couldn't even agree on the direction of the threat.
Right.
You had one official voting to cut rates, arguing that the manufacturing sector and commercial real estate are already suffocating under current borrowing costs and need immediate relief.
While the others went the exact opposite way.
Exactly. The other dissenters wanted to hike rates, arguing that the combination of oil shocks and tariffs is going to reignite a 1970s-style inflation spiral. They are looking at the same autonomy and diagnosing 2 entirely different terminal illnesses.
Think of the global economy as a car right now.
Yeah.
The temporary 15% tariffs are slamming the gas pedal. They artificially pump up the cost of consumer goods, forcing people to spend more for the same items, which drives inflation higher.
Right.